2.8%, up 2.9% from a year earlier. Let's bring in Ryan Felsman from Colonial First Aid Global Asset Management. I want to get your thoughts firstly, just
James.
on that wages data, Ryan. What did you make of it?
I think the wages data was expected, James. If you look at the last 18 months, there's clearly been a slowing in terms of wages growth, particularly around the subdued labour market. So the outcome today wasn't a great surprise. Certainly the overall headline number of 2.6% annualised was expected by market participants. One of the interesting outcomes, though, was around the public sector, where there was wages growth of 0.8% for the quarter and 2.9% annualised, and that was the fastest increase in about 12 months. So that's very interesting given the dynamics around the federal budget, of course, and the likelihood of 16,000 jobs going in the public service.
Does it play into the RBA's thinking at all, do you think?
I think it confirms that inflation remains fairly subdued or contained at present. Certainly there won't be any wages pressures over the rest of this year or the course of this year to certainly increase interest rates from that perspective, but certainly negative real wages growth is going to feed into this whole story, of course, around the consumer, where there's some weakness there.
Well, tying that into the weakness we saw from the consumer read today, as well as falls in the iron ore price, people talking about a potential rate cut again, Ryan?
James, I think the hurdle for rate cut is still fairly high. I think we'll have to see a substantial, sustained decline in terms of consumer confidence and also business confidence. People aren't really talking about the business confidence survey from the NAB that was released a couple of weeks ago, and that survey showed that confidence remained fairly resilient in the face of the budget in terms of the uncertainty around that. Granted, domestic demand still remains fairly weak. Businesses are still reluctant to hire and spend and invest at the same time, but certainly that element is very important, and they remain fairly resilient in the previous survey. So it'll be interesting to see in the next survey from the NAB whether we see this type of collapse we saw today in the consumer confidence survey.
Well, I mean, is it enough to, discard today's sentiment survey? It's worth noting every May for, the last few years we've seen a big drop as people digest the budget. So I wonder if it's just sort of almost a yearly anomaly.
That's a very good point, James. I mean, if you look at last year, for example, consumer confidence fell by 7%, so almost identical to the result today. And in June, the month after, it actually increased by 4.7%. So the question is whether this outcome is a temporary outcome. Certainly, if you look at the underlying sub-indices in the survey, family finances over the next 12 months were hit very severely at 40-year lows of around, or the decline was 23.2%, a 40-year low. And certainly, in terms of the desire to purchase a dwelling or a house, in the near term had fallen by 6.1%. So one of the really negative aspects of the survey itself. But if you look at the medium-term components of the survey, certainly around economic conditions in 5 years, that actually picked up by 11%. And also time to buy a household item picked up by 3.2%. So I think consumers, while quite annoyed by some of the measures outlined in the budget, certainly around the reduction in government spending, which will affect family benefits, entitlements around welfare, obviously the deficit levy as well, while they're quite annoyed about that type of aspect of thing, I guess at the same time they realise that there's a need for fiscal consolidation and repair at the same time. And that's reflected in that medium-term outlook, perhaps. Where's
the strength that will, if you like, stay the RBA's hand in regards potentially cutting rates, but also have them look, as some suggest, albeit pushing out to sort of 2015, 2016, looking at rate hikes? Where within the economy, and what's the data that gives that credence?
Well, certainly the fiscal situation is a little bit of a concern. I mean, the RBA has factored in the reduction in public demand in terms of their forecasts. If you look at the actual fiscal consolidation that the government's just announced, it's nowhere near as severe as the 1996 budget. It's about a third as severe as that. So while there's a lot of anxiety in the public around some of the announcements, if you look at the total aspect of it, it's not quite as bad as expected. But certainly the fiscal drag on the economy should be around 0.5 percentage points. So that will have some impact, certainly, in terms of economic growth. The key element, of course, is around the labour market, in my view. RBA is expecting an unemployment rate of 6.25%. The Treasury is expecting 6.5%. They're being cautious. The question is whether the labour market, in terms of the unemployment rate, has peaked at around 6.1. It's currently 5.8%. And if you look at the job vacancies data today from the Department of Employment, that continues to show a stabilisation in terms of job ads, a bottoming in terms of job ads, and certainly that's reflected in the fact that we've created about 107,000 jobs in the first 4 months of this year. That's the strongest outcome in 6 years. So that's kind of the key caveat to all of this, I guess, the employment situation.
Do you think we've seen the peak at 6.1?
Possibly. I mean, if you look at the SEEK index for May, for example, it increased by 5.5%. So certainly we are seeing a pickup in job ads, a bottoming there. So if we can see a sustained improvement there, that may lead to the RBA normalising interest rates certainly a couple of quarters after the peak. So there's a possibility that that may eventuate.
Where does it leave your own forecasts for the cash rate?
Well, our view presently is that we think that the RBA will most likely increase rates next. As I mentioned, the hurdle for a cut is certainly quite high. In the near term, they're certainly on hold, but our view is maybe in Q4 they'll look to increase rates. Certainly the housing market's still buoyant, so there's pressures in that regard. Inflation headline is 2.9%, while it's still contained within the 2 to 3% range. It's certainly at the top of the range, or at least at the midpoint of the range. And at the same time, we've also seen building approvals increase quite well. Consumer spending has increased for 11 consecutive months. Of course, whether there's a hit to that, we don't know yet, but certainly there has been a bit of a disconnect between consumer confidence and retail spending at the same time over the last 12 months. So that is quite an interesting dynamic.
Absolutely. Ryan, great. Thanks very much.
Thank you very much, James. Much added.
Ryan Felsman there from Colonial First Aid Global Asset Management. Well, Network 10 CEO Hamish McClellan has major job cuts. The Channel's news and operations departments